Every day we turn on the news or pull up our phones, we are inundated with the most recent policy, executive orders, political disputes, and changing economic reality here in the United States. All of this uncertainty has made a lot of dividend investors nervous and thinking about how to broaden our dividend portfolio exposure outside of the United States. So with that in mind, I'm going to talk about 4 great internationally focused dividend ETFs that you may want to consider. I'll also tell you which one I'm actively adding now. So today, we're breaking down 4 of the best international dividend ETFs. We're going to be talking about IDVO, the Amplify International Enhanced Dividend Income ETF, IDV, the iShares International Select Dividend ETF, SCHY, the Schwab International Dividend Equity ETF, and VYMI, the Vanguard International High Dividend Yield ETF. We'll cover their investment strategy, dividend yield, dividend growth, expense ratios, top holdings, and the total returns over the past 5 years to see which might be the best fit for your portfolio. Before we dive in, though, smash the like button and subscribe to Dividend Stockpile for more insights on everything dividend and income investing related. Okay, first up is IDVO, the Amplify International Enhanced Dividend Income ETF. This is a covered call ETF that selects high dividend international stocks and writes options to generate additional income. The ETF is managed by the same team that brought you the amazing DIVO ETF. Just this one focuses on non-US companies. It's the same formula and same methods. So let's talk about how they run this ETF. First up, they find dividend growers. They identify ADRs, which are American Depository Receipts of high-quality, large-cap companies from the MSCI ACWI ex-US Index that they believe will, over time, sustain their earnings and cash flow and increase their annual dividends consistently. Then they take sector allocation. The portfolio managers consider which industry sectors or countries appear to be outperforming relative to the overall market and overweights those sectors or countries by selecting securities that are outperforming relative to their peers. They assemble a portfolio of 30 to 50 securities on a normal basis that have been screened according to attributes such as earnings, cash flow, return on equity, market capitalization, and management track record. And then they do a tactical covered call strategy on select stocks within the portfolio to enhance the yield. Speaking of dividend yield, right now it's about 6%. And of course that varies depending on the options they receive and the dividends paid, but it is paid monthly. According to management, their goal is 3 to 4% a year in dividends and about 2 to 4% in covered call income. That's how they come up with their expected yield. The dividend growth will vary depending on the stock selected as well as the options premium received, but with their limited time period, they've been able to increase it 11% over the last year, and they just started in September 2022. Their expense ratio is 0.66%, which is higher due to the fact that it's an actively managed fund. Looking at their allocation by country, their United Kingdom is 16%, Canada 13%, Brazil 8%, China 7%, and Germany 6%. They only have 68 holdings as of right now, including the options. Their top 5 holdings as of the recording are Tencent, Barclays, SAP, Anico, Eagle Mines, and RELX PLC. The total average return for this ETF, we don't have a full 5 years, but it has averaged a little over 16% a year since inception. So who should consider IDVO? Well, I would say investors looking for high income through an active manager that blends dividends and covered call strategies, and those who prioritize monthly cash flow, and then capital appreciation on top. Next up, we have IDV, the iShares International Select Dividend ETF. Their strategy is investing in high-yielding international companies, tracking the Dow Jones EPAC Select Dividend Index. So why would someone invest in IDV? You get exposure to established high-quality international companies. You get access to developed market stocks that have provided consistently high dividend yields over time. And it's easy to use to expand your income strategies to international markets. As of right now, they have 98 holdings, and their dividend yield is about 5.90%, and it pays quarterly. This is a passively managed ETF. It does track the index, so there's no active manager, and it started back in 2007. One surprising point is the expense ratio is relatively high at 0.49%, and their top countries have 24.74% in the United Kingdom, Italy is at 10.7%, Spain 8.85%, Canada at 8.53%, and France at 7.06%. With that, their top 5 holdings include British American Tobacco, Imperial Brands, ENEL, Total Energies, and BHP Group. So their 5-year total average return, including dividends, is 6.62% a year, which is pretty good. driven primarily by the dividends rather than the price growth. So who should consider IDV? Well, income investors looking for strong dividend yields from developed markets, and one who provides a high, stable yield over a growth-focused ETF. Next up, we have SCHY, the Schwab International Dividend Equity ETF. Their strategy focuses on quality international dividend growth stocks with sustainable payout ratios. It's the exact same strategy as SCHD, but for non-US companies. So why would someone want SCHY? Well, first off, it's a straightforward, low-cost fund and offers potential tax efficiencies. The fund can serve as a core or a complement to a diversified portfolio, and attracts an index focused on the quality and sustainability of dividends by screening non-US companies based on 4 dividend quality attributes. And it invests in non-US high dividend yielding stocks with a record of paying dividends for at least 10 years. They look at financial strength, and they're screened for lower volatility. The total holdings right now is 135 holdings, and the dividend yield is 4.35%. The dividend growth has been strong, averaging around 10% since inception, by targeting companies that are consistently raising their payouts. That said, this particular ETF was only started in April 2021, so we don't have the full 5 years. But one great thing about this particular fund is the very low expense ratio, 0.08%, one of the lowest of the international dividend ETFs. Top countries right now include United Kingdom at 15%, Australia at 11.76%, France at 11.37%, Japan at 10.66%, and Switzerland at 9.32%. Top 5 holdings are Roche Holdings, Vinci SA, GlaxoSmithKline, Total Energies, and British American Tobacco. Unfortunately, their 5-year total return average has not been so great at only 3.19%. Who should consider SCHY? Well, those long-term investors who prioritize dividend growth. And you also want a low-cost international dividend ETF with an established track record of the methodology. And last up, we have VYMI, the Vanguard International High Dividend Yield ETF. Their strategy invests in high dividend yielding stocks from developed and emerging markets. So why would someone pick VYMI? It seeks to track the performance of the FTSE All-World ex-US High Dividend Yield Index. Provides a convenient way to get exposure to international stocks that are forecast to have above average dividend yields. It is a passively managed approach, and they do sample from around the index. This fund is a favorite of my friend and fellow dividend YouTuber, Colby, from the DGI Crab. He recommends this as a strong international dividend ETF. If you haven't checked out his work, I have a link in the description. Show him some love by subscribing, watching a couple of his videos, and tell him I sent you. Alright, let's continue on to VYMI. Their total holdings right now is 1,498 holdings. Their yield is 4.51%, and they have a moderate growth rate of the dividend at about 4.61% on average for the last 5 years. Their expense ratio is only 0.17%, very reasonable. And it started all the way back in February of 2016. Top countries are Japan at 13.8%, United Kingdom at 12.1%, Canada at 8.1%, Australia at 7.5%, and Switzerland at 7.5% as well. Their top 5 holdings are Roche Holdings, Toyota, Nestle, Novartis, and Shell. So over the last 5 years, on average, the total return has been 9.92%, which is a great return, and it offers a mix of income and growth. So who should consider VYMI? Well, it's for those investors seeking a very well-diversified international dividend ETF, so this has almost 1,500 holdings, and those looking for a mix of high yield and long-term capital appreciation. So let's recap each with a side-by-side comparison. So we start with IDVO. The yield is around 6%. Dividend growth, while only 1 year, is 11%. Expense ratio is 0.66%. And the return has been about 16% a year, but remember this is a new fund, and their focus area of covered calls and dividend income. Next up, we have IDV with a 5.9% yield, and dividend growth over the last 5 years of only 0.45%. Expense ratio at 0.49%. 5-year return of 6.62%, and they are focused on high yield investing. Next up, we have SCHY at a yield of 4.35% and about a 10% dividend growth rate, but they've only been around for about 3 years of increases. Their expense ratio is very low at 0.08%, but their 5-year average return is relatively low at 3.19%. And this particular fund focuses on dividend growth. And last, we have VYMI with a current yield of 4.51 and a 5-year dividend growth of 4.61. Has an expense ratio of 0.17% and a 5-year average total return of 9.92% a year. This is a balance between the yield and growth. So, just some high-level picks based on your investment goals. If you're looking for high income, IDVO might be a good choice. If you're looking for dividend growth and total return, VYM stands out. And if you want to take a balanced approach, SCHY provides a great combination of current yield and dividend growth. For my own personal situation, my timeline, and my investing approach, it comes down to two of these names, VYMI and IDVO. VYMI is a solid fund with a great history, but I'm a little concerned with the vast number of holdings and the lower dividend growth. IDVO, I really like the portfolio manager and the approach of using covered calls and dividend growth stocks. This might provide a more robust return profile throughout the years, but the active management fee is something to consider. So, the one I'm going to go with on my personal account, and remember this is not financial advice, but I'm going to go with IDVO. The combination of dividends and options, as well as having a portfolio manager picking quality companies for me, is worth the extra costs. Even though it's a newer fund, the manager has been doing dividend and option strategies for years, and the results of DIVO show that this strategy does work. Alright, international dividend ETFs can be a powerful way to diversify your portfolio and boost your passive income. Whether you prioritize high yield, dividend growth, or total return, one of these ETFs could be a great addition to your portfolio. So here's the question for you. Which of these ETFs fits your investment strategy? Let me know in the comments. And, as always, if you found this video helpful, please hit the like and subscribe button. And thanks for watching. Remember, keep stockpiling those dividends, and we'll see you next time on Dividend Stockpile.